We joined by two experts. Firstly, from an FII perspective, Adrian Mahesh, MD and Chief Emerging Market Strategist at JP Morgan Asset Management, joins us on the line from Hong Kong. In a bit, we'll also get in Mahesh Kumar, Senior Associate, and Nishit Desai, Associates, on the show. Adrian, I'll come to you first. What's your sense? Because there are conflicting views coming out here. One which says that there could be a relief given to FII investments per se, because the whole idea or purpose behind this is essentially to ensure that the Vodafone type cases don't happen. What's your sense? I'm sure FIIs are nervous, but can this continue over the issue?
Look, just to clarify something, I don't work for JP Morgan Asset Management. I work for JP Morgan Securities. My role is to advise fund managers. I'm not a fund manager. But I was a fund manager running an India fund back in '93. I spent many a board meeting dealing with ambiguities over tax treaties with India. It makes India absolutely unique globally that this debate is still going on. And I wish we could just move on from this and understand that you do not charge tax to wholesale investors. Just to clarify, that means pension funds, insurance companies, mutual funds, because the underlying or the ultimate shareholder, pensioner, investor will be paying tax. So most countries have double taxation agreements, so that means when their mutual funds invest in the other country, they don't pay tax, and when mutual funds from that country invest in the other country, they don't pay tax. India really needs to clarify this, move on. We don't want to have this debate every year, and there is just, I don't know quite now how to express how frustrating this is for international investors. India's running a big current account deficit. It needs other people's capital, particularly with oil at $123 US. But it doesn't need to make itself unique, standing out as being competitively, massively disadvantaged in global capital markets by these sort of constant retesting of tax treaties.
So, Adrian, what is the biggest fear right now? And also, is moving to Singapore also an option? And how easy would it be to pull out of Mauritius and actually move to Singapore? Because the bigger concern is that, the safe haven route to Mauritius is now closed.
Well, the fact you have to go through Mauritius makes India a massive puts India at a massive competitive disadvantage. Our clients do not have to jump through these hoops, in order to invest in other countries, right? It's only India that seems to misunderstand the way you treat international wholesale capital. You do not penalize it by taxing it twice. So you shouldn't have to move your domicile from one country to the next. A US-based institution should be able to invest directly in India without having to pay double tax, i.e. you tax the wholesale entity and the end investor gets taxed. So yes, you can move to Singapore, but that just adds additional cost, administrative burden. And think about this, emerging markets are only 15% of global equity markets. India is less than 1% of global equity markets. There'll be a lot of investors that just say, why bother? It's a competitive world out there for capital. India needs the capital. Let's stop putting these hurdles in the way.
So, Adrian, what do you think is going to be the repercussion of this? Are we going to see large-scale unwinding of P-notes as well as ETF money?
If the current ambiguity continues, absolutely you will, because why are you going to invest in a country that charges you tax when other countries do not charge you tax as a wholesale investor? The only reason you will do that is if you believe that the return is so large that on an after-tax basis it's going to be more attractive to invest in India than it is in other emerging markets. And, I'm not sure if the returns out of India will be high enough to justify that extra burden. But absolutely, this will lead to a capital outflow at a time when the country needs the money.
Fair point. Adrian, let's try and get some clarity on when and if this becomes a done deal. Just stay on. We'll get a legal opinion as well, Adrian, and come back to you because would want your opinion on what this gentleman has to say. Mahesh Kumar, Senior Associate at Nishit Desai Associates, joins us on the show as well. Mahesh, good to have you. What's your sense? I mean, you just heard an FII view saying that money is absolutely needed and the ambiguity needs to be cleared. The question mark is, what if the ambiguity gets cleared in a way that FIIs don't like? This becomes a done deal, and it's applicable to FII investments routed through all routes as well.
Yeah, absolutely. I completely agree with Adrian that the GAR proposal is going to be a real dampener. It is going to really affect strategies of not only FIIs but other strategic investors, and it is going to have a serious impact on all sorts of transactions, whether they're mergers and acquisitions, and as well as domestic transactions, and for that matter, even Indians investing globally. So the impact of the GAR provisions can be very wide. They are going to create immense uncertainty in the country, and especially at a time when India needs foreign capital, at a time when we need to meet huge public expenditure, and we need to provide a stimulus to capital formation in the country. This is definitely not the right time to introduce such a move.
Said that, Mahesh, the question mark really is that how likely is it that the tax will be claimed with a retrospective effect on historical transactions as well, because that is something that will really dampen sentiments for FII investors.
Yeah, so the proposal in the budget is that the GAR provisions will apply from April 1, 2012 onwards. So the idea is to make it prospective. But it is not as simple as that, because the GAR provisions essentially apply to arrangements and even a step in an arrangement. So potentially, even if it is an arrangement that exists today, but that may lead to a transaction, say a divestment or a sellout sometime in the future, post April 1, 2012, potentially can still be covered, which is something completely contradictory to what the Standing Committee of Parliament has even suggested in its very elaborate report, where they have said that there should be grandfathering of existing structures because taxpayers have planned their affairs and invested, whether through Mauritius or Singapore. They have understood the law. They have invested in a certain manner. You cannot penalize them for something that has happened in the past. It is unconstitutional as well.
Right. Mahesh, just to stretch that point forward and bring in some more clarity on P-notes really. Investments or profits made through P-notes will be subject to tax, and even investments routed through companies in Mauritius probably will be taxed. So that is what the document is saying. Is there any reason to believe that these kind of investments will be subject to short-term as well as long-term capital gains tax?
Yeah, potentially it can be subject to either of them. Because essentially the object of GAR is to remove, it allows the tax department to deny a tax benefit, which is probably allowed under law, to deny a tax benefit in cases where, based on mere perception, it is considered that an arrangement, say whether it's a P-note or whether it's a fund structure through Mauritius or Singapore, the mere perception that the object was to avoid Indian tax. So they're able to deny this tax benefit. It could result in long-term as well as short-term capital gains tax.
Adrian, I'm giving you a hypothesis. It doesn't become for retrospectively, as in it does not probably involve historical transactions done, but it does become a norm or it does become a law that all such transactions will be subject to tax, and the new laws will override any kind of tax avoidance treaties that India has with certain tax havens. What happens to prospective investments from FIIs? Do they get routed through other areas or other countries? Or for the near term, FIIs will just be skeptical about investing in India?
I think it has to be the latter, because you made this comment on it overrides tax treaties. So someone has made a decision to put capital into India based upon the legislation and the tax treaties that are in place. And retrospectively, we're changing that. That is a significant policy risk for investors to take on in investing in India. And, they move to Singapore and then they find that the same thing happens with Singapore that's happening potentially with the Mauritian tax treaty. This is simply bad for the market. It's bad for the country. It's bad for the cost of capital in India. It's bad for growth. It's bad for employment. And it's bad for India's global reputation. We need to clarify this. We need to move on and let India have the same standing as any other emerging market, let alone developed market, in the way that it treats wholesale capital.
So, Adrian, given the concerns that you just reiterated, what's the possible downside that we could see in equities at the current juncture?
Well, I think you will see, at the moment, what investors are saying is, look, we keep on retesting the Mauritian tax treaty, and it really has been going on since '93 when people started to use the Mauritian tax treaty. And that there's just a view that sense will prevail and that they won't go through. And so if, as the legislation is, and it hasn't got to the lock Sabbath, if it stands, then I think you will see significant selling because investors haven't sold yet with the view that sense will prevail.
Okay, Adrian, we'll leave it at that. Thanks so much for joining in today and giving us that perspective. Mahesh, one final word. There was a note which said that it is also likely that a representation would be made to exempt FIIs from this, as the key objective of this law is to avoid the Vodafone type cases. You think that could be a possibility, that FII investments could be exempt, but there will be specific cases so that a Vodafone type of case doesn't happen again? Could that be the main objective, and therefore could this respite be given?
Yeah, so one thing is the Vodafone type cases where you have transfers at an offshore, share transfers at an offshore level. The other thing is the use of some of these holding company jurisdictions such as Mauritius and Singapore. Now the GAR proposal is potentially it targets both the use of intermediary jurisdictions such as Mauritius or Singapore, as well as Vodafone type situations where you have share transfers at an offshore level. And in addition to GAR, they also propose to introduce this retrospective amendment, which seeks to overrule the Supreme Court's decision in Vodafone and tax such offshore share transfers. Now, I hope that at least in the cases of FIIs, and as Adrian said, pension funds, insurance companies, people making genuine investments in India, to avoid situations of double taxation in both India and in whether in the US or in the UK, it is necessary to provide some sort of exemption for portfolio investors at least.
Okay, would have loved to talk more. We can go on and on with this, but the gist has been derived. Thanks so much, Mahesh, for joining us today and giving us your side and your perspective as well.